In the fall of 2008, kitchen tables became crisis centers across American neighborhoods. People watched retirement accounts shrink overnight, while paychecks suddenly felt less certain everywhere. A house was supposed to mean safety, yet it began to feel like a trap. News anchors said markets, but families measured it in groceries, gas, and missed payments. How did a Wall Street storm reach ordinary living rooms so quickly and so hard? Tonight, we follow the chain from easy credit to shattered confidence in everyday life. We will see who designed the system, who trusted it, and who absorbed the damage. We will track one promise: homes rise, jobs hold, and savings grow steadily. Then we watch that promise crack, first quietly, then all at once nationwide. And we show what the crash changed long after the headlines moved on. At the start, America was coming off a long boom and very low interest rates. Banks, brokers, and borrowers believed housing could carry the economy forward without limits. Suburbs spread, cranes swung, and for sale signs turned into sold stickers quickly. In many towns, rising home values felt like a second paycheck arriving each month. Mortgage ads promised speed and simplicity, and paperwork became thinner and faster every year. Some loans began with low teaser payments that climbed later, sometimes sharply higher. Borrowers with shaky credit were approved because the house itself looked like security. Lenders often sold those loans onward, so quality mattered less than sheer volume. Wall Street bundled mortgages into securities, turning thousands of payments into tradable products. Ratings labels made risky bundles look safer, like smoke painted to resemble clear air. Investors worldwide bought those bundles, hungry for yield in a world of cheap money. Meanwhile, regulators trusted models, and lenders trusted rising prices more than income checks. Families used refinancing to cover bills, remodel kitchens, or send kids to college. Real estate shows celebrated flips, and dinner talk included equity and appreciation casually. Cities and counties enjoyed new tax revenue, and builders hired crews almost everywhere. But the boom depended on constant motion, like a bike that falls when stopped. By 2006, prices slowed in many places, and the easy exits disappeared suddenly. Delinquencies rose first in subprime neighborhoods, then crept quietly into the middle class. Adjustable rates reset, and monthly payments jumped beyond what stretched budgets could handle. Foreclosure notices multiplied, and vacant homes dragged down whole blocks like heavy anchors. As prices fell, refinancing vanished, leaving families trapped in loans they could not escape. The machine that fed on new mortgages began to choke on old ones. Securities tied to mortgages lost value, and nobody was sure what anyone held. Banks stopped trusting each other because hidden losses could be anywhere on balance sheets. That mistrust froze lending, the quiet plumbing that keeps business life flowing day to day. In 2007, subprime losses spread through hedge funds and bank portfolios like dye in water. By early 2008, foreclosures surged, and housing prices slid harder across wider regions. In March 2008, Bear Stearns collapsed, signaling that the trouble was not contained. That summer, Fannie Mae and Freddie Mac teetered under enormous mortgage exposure nationwide. In September, Lehman Brothers failed, and fear turned into a full financial panic. Money market funds wobbled, credit markets froze, and companies struggled to borrow for payroll. The government rescued AIG to prevent a chain reaction across the financial system. Suddenly, even solid firms faced doubts because nobody trusted the numbers behind the doors. The phrase, toxic assets, entered daily speech, yet it felt like invisible poison. At the heart was leverage, borrowed money stacked on borrowed money, amplifying every mistake. Complex derivatives promised protection until the sellers of protection could not pay up. Short-term funding kept institutions alive daily, like oxygen tanks that suddenly emptied fast. When collateral values fell, lenders demanded more, and forced selling pushed prices down further. That spiral hit stocks too, draining 4-0 wonks and pensions as if a plug was pulled. Central banks poured liquidity into markets, trying to keep credit lines from snapping completely. Congress debated rescue plans while families watched confusion spread across every channel nightly. Emergency programs aimed to stabilize banks, because a collapse would crush jobs everywhere. But stabilization for markets felt abstract to households dealing with real deadlines and letters. The turning point was psychological, as much as financial. Trust cracked, and fear took over. Once fear ruled, spending slowed, hiring stopped, and a recession deepened across the country. Factories cut shifts, retailers cut staff, and service jobs vanished in wide waves. Foreclosed homes sold cheap, pulling nearby values down and erasing more family equity. Local banks tightened loans, even to steady customers, because regulators demanded more caution. Everyday credit became much stricter, and small risks suddenly carried big penalties too. By late 2009, the freefall eased, but the damage was already deeply personal. For older workers, retirement dates shifted, not by choice, but by sheer necessity. For younger families, daycare, car payments, and mortgages competed inside a shrinking paycheck. Job losses spread from construction to finance, then to factories, stores, and schools. Small businesses lost credit lines, even with steady customers, because banks hoarded cash. Home equity lines vanished, removing a common cushion for medical bills and emergencies. Some families moved in together again, turning spare bedrooms into lifeboats for relatives. Others packed trucks at night, embarrassed, leaving keys on counters in foreclosed houses. Marriages strained under quiet fear, as partners hid bills to avoid another argument. Children noticed fewer birthdays out, fewer trips, and a different tension in adults. College plans changed, as savings fell and loans suddenly felt heavier than expected. Health insurance was lost with jobs, making sickness financially dangerous, not just painful. Communities saw property tax revenue drop, and school budgets tightened accordingly year after year. Police and fire departments faced cuts, even as stress-related calls and crime rose. Meanwhile, some investors bought distressed homes cheaply, turning pain into opportunity for themselves. Banks that survived gained market share, while smaller institutions disappeared or merged quickly. Many executives kept bonuses, and that contrast hardened public anger into lasting distrust. Yet some homeowners received modifications, and a few programs slowed the foreclosure wave. The rescue stabilized markets, but it did not restore vanished years or lost confidence. Credit standards tightened, making it harder to buy homes, cars, or start businesses. Families learned new habits, like keeping cash buffers and treating debt with caution. But wages stayed flat for many, even as the economy later recovered on paper. Neighborhoods with the most foreclosures took longer to heal, and some never fully did. Stress showed up in clinics and classrooms because money pressure rarely stays only financial. People delayed marriages, delayed children, or delayed moves, waiting for stability to return. Even those who kept jobs felt poorer, as raises vanished and benefits were cut. The crash changed culture too, turning the home from trophy into a question mark. Trust in banks, ratings agencies, and experts eroded, and skepticism became the default. Politics absorbed that anger, and debates over bailouts shaped elections and new movements. Some blamed borrowers, others blamed bankers, and many blamed rules written for insiders. New regulations arrived, aiming to reduce risky lending and increase transparency in finance. Still, complexity remained because incentives to chase profit returned quickly whenever memories fade. Renting grew, and the idea of a forever home weakened for many families. Consumer confidence took years to rebuild, and spending patterns stayed cautious and selective. Wall Street recovered faster than Main Street, feeding a sense of two economies. Schools and charities faced heavier demand, as communities tried to patch holes together. The story of 2008 is not only about banks, but about everyday vulnerability. It taught that stability can be fragile when promises depend on ever-rising prices. It showed that crises sound technical in public, yet feel intimate in private homes. Families carried the losses quickly, while recoveries arrived slowly, unevenly, and sometimes never. If prosperity is a story we tell ourselves, who gets to write the next chapter? In the years after, many rebuilt credit step by step, learning patience the hard way. Others carried damaged scores, facing higher rates that punished them long after layoffs ended. Some families sold beloved homes, downsizing to rentals, chasing stability over pride quietly. Older parents helped adult children with rent, reversing expectations of independence and progress. Many workers accepted lower pay, trading ambition for benefits, and a predictable schedule. Retirement portfolios recovered in markets, but lost time could not start compounding again. A generation remembered bank lobbies and foreclosure courts more than booming open houses. Financial literacy grew popular, yet it often arrived after the tuition of mistakes. People began reading fine print, asking harder questions, and keeping emergency funds regularly. Community groups fought foreclosures, proving neighbors could be stronger than distant paperwork together. Local leaders learned that housing stability affects health, education, and public safety directly. Builders slowed for years, contributing to later housing shortages and higher rents today. Young adults waited longer to buy because down payments felt impossible without family help. Older homeowners grew cautious about borrowing against houses, treating equity as real savings. Many families kept older cars longer, repaired appliances, and postponed vacations without complaint. Churches, food banks, and schools quietly filled gaps when formal systems moved too slowly. Some people never returned to investing, choosing cash over markets they no longer trusted. Others diversified more, spreading risk because they had seen one asset class collapse. Careers changed as workers retrained, moved states, or accepted gig work to stay afloat. New technology companies rose during recovery, while old industries continued shrinking or automating. The crash also reshaped family stories, marking years as before and after that autumn. Children who watched layoffs grew into adults who valued security more than prestige. Yet resilience grew too because people still built lives on modest plans and steady work. Memory fades, but warning signs remain. Debt can grow faster than income for years. And the simplest lesson endures. Ordinary families need margins, not miracles, to feel safe.